Thank you, Mr. Chairman, very much. Mr. Hochberg, a stated goal of Ex-Im Bank is to provide export credit assistance to serve customers that are unable to obtain financing through the commercial markets. What policies and procedures does the bank have in place to ensure that it is limiting its assistance to these customers and not crowding out opportunities for private capital markets? And does Ex-Im make any kind of formal analysis of what kind of private capital would enter markets in its absence?
Each application must state unequivocally why they're looking for our support and why they can't find it in the private sector. That's a requirement in reviewing a loan application, whether it's lack of financing, meeting the competition. Sometimes banks have limits on what they'll do in certain industries or certain countries. That's where we step in. Sub-Saharan Africa is a good example of that. We did a lot of loans in the Philippines. I have a list here. In Cameroon, I think I mentioned earlier, over half the exports that went to Cameroon, for example, we finance. Why? It's very hard to get any bank to step forward. In places like Western Europe, we do very little business because the banks are able to do that. Japan, we hardly do any business. There's a well-defined banking system.
Well, let me ask Mr. Sira. Let me ask the GAO. Is Ex-Im doing enough to ensure that companies are going out into the private market and not finding capital before coming to the banks?
Sorry. I think that gets into sort of the underwriting and what they're doing in terms of looking at eligibility and the analysis that's done there. And we have work underway right now that's looking at that, but that work is not yet complete. I would point out that we had made some recommendations back in 2007, and this is just to clarify a point. Although Ex-Im has been very cooperative and has agreed with our recommendations, not all have yet been implemented, and so there's some from back in 2007 which look at some of this economic impact that it's still working on.
Okay. Well, let me ask also in terms of the numbers and what numbers are right. Both sides of this debate are claiming numbers that support their case based on different accounting methodologies. So the bank claims estimates that it made $1.6 billion in revenues for taxpayers since 2008. Yet, as you know, and it has been cited here today, the CBO reported on May 22nd that if Ex-Im used the fair value accounting method, it would be budgeted as a $200 million cost to the taxpayers each year. Dr. Elmendorf, can you explain the large gap in numbers between these assessments? And in your response, can you touch on what kind of risk assumptions you use in terms of losses and when you apply this fair value methodology? And do you look at historical experience and commercial bank experience, and do you factor in loss reserves and capital? Maybe a quick explanation of how you do this.
Yes, Congressman. When the government makes a loan or makes a loan guarantee, either through Ex-Im Bank or some other credit program, the ultimate budgetary effects of that are not known. Some loans, many loans, most loans are repaid. Some loans are not repaid or are repaid in part. Sometimes some money is recovered. The ultimate budgetary effects aren't known until after the fact. So last year, Ex-Im turned over some amount of money to the Federal Treasury. That's certainly true. When we give the Congress cost estimates, we're trying to give you a sense of what will happen going forward under a certain program from a certain bit of financial assistance. And those estimates are operating in a world of great uncertainty. What the fair value methodology does is to capture in the estimate not only the expected level of default and recoveries, but the variation around that expectation, and to recognize how the possible outcomes are correlated.
Let me put it another way. What I'd be interested in is the risk analysis framework that's employed in accounting by the private sector creditors.
Right.
If you did that.
So private sector creditors take account of this market risk and put a price on it because the risk is costly to investors. In
your opinion, if you did that, would it be a $200 million cost to the taxpayers, or would it be a
yes,
return?
So Congressman, when we applied that methodology to the Ex-Im Bank's projections of the size of the credit programs they will run, of the default rates and recovery rates and so on, taking the same set of underlying cash flows that appeared in the credit supplement to the President's budget and that we use in our standard FICRA accounting, we use those same underlying cash flows but applies as cost for market risk, then the Ex-Im Bank's programs are costly by our estimate to the tune of $200 million.